A few years back, quitting the day job and trading full time was the dream of many youngsters. But now ask all the experienced traders, none of them suggest full time trading as a career option. Because market dimensions has changed a lot, there are changes in rules very frequently, difficult to generate good returns every month, and one spike on a bad day can wipe out your entire capital. Does that mean everybody should quit the stock market? Need not be. One can continue with their day job or business and also earn good returns on their capital if they invest in good stocks for the long run. Look at some of these examples. BHEL has generated 224% returns since 2023. Oil India has generated 196% returns since 2023. NTPC has generated 110% returns since 2023. If you diversify your capital on similar stocks like this, you don't have to worry about spikes, big falls, gap up or gap down open on daily charts level. Then, how to find good stocks for the long-term investment? In this video, I will break down a complex theory into a simple modules and anybody can understand how to pick good stocks for the long-term investment. So without wasting much time, let's start. Friends, take any market, cash market or commodity market or forex market, price can move in upside direction or downside direction or sideways direction, right? Any market should move in any one of these direction. Apart from these three direction, any market will not go in any other direction, right? Now the thing is, let's say it's going upside. The thing is, price will not go upside in a single straight line, right? It will give small pullback and go up, small pullback and then go up. It gives small pullback and go up. While going down also, it gives a small bounce and then it goes down. It gives a small bounce and then goes down, right? So we can study all these variations using Dow theory. Okay, this is very simpler and effective manner to study these variations using Dow theory. So Dow theory is proposed by Charles Dow. Basically, he wrote series of articles in his journal, Wall Street Journal, and explained Dow theory in many articles. In this video, I'm trying to explain the entire Dow theory in simpler and effective manner as much as possible. So according to Charles Dow, price can move in three trends, uptrend, downtrend and sideways trend. Now let's study one by one in detail, okay? So number one is uptrend. Let's say the price has started its movement from here. So this is the swing low and this is the swing high. This is the starting swing low and this is the starting swing high, right? Now when price starts moving, okay, it makes an higher low, okay, as compared to the previous swing low, the original swing low, it makes an higher low, right? Then it makes an higher high as compared to the previous the starting swing high, it makes an higher high, right? So in an uptrend, price keeps on making higher low, higher high, higher low, higher high, higher low, higher high. So in other words, when the price keeps on making higher high and higher low, we can say that the price is in an uptrend. Now let's say you are holding some stocks in your portfolio. If one of the stock is displaying this pattern, it indicates it is in a uptrend and you should try to or you should aim to carry that particular stock, because you never know where the price will go, right? So starting from 100, it can go to 1000, 2000, 3000. So there is a possibility. So until price displays these characteristics, higher low, higher high, higher low, higher high, you can conclude that that particular stock is in a strong uptrend and you should try to ride the profits as much as possible. Okay. Now this is an example of uptrend in Titan monthly chart. Okay, let's say this is the starting point and this is the starting swing low and this is the starting swing high, right? Now compared to the starting swing low, this is a higher low, right? Then compared to the starting swing high, this is a higher high, right? See, price kept on making higher low, higher high, higher low, higher high, higher low, higher high, which means it is in a strong uptrend. If you are holding this stock means you should try to write the profits as much as possible. Okay, so this is one example. So one more example is Bajaj Finance weekly chart. Okay, so this is also in a strong uptrend. Now see, compared to the starting swing low, it kept on making higher low, higher high, higher low, higher high, higher low, higher high, right? So it is in a strong uptrend. Once again, if you have any, these kind of stocks in your portfolio which are displaying higher low, higher high formation, you should try to hold that particular stock and try to write the profits as much as possible. Now, downtrend. Okay, I hope uptrend is clear, right? Higher low, higher high, higher low, higher high, higher low, higher high. Now downtrend. So in downtrend, what happens is, let's say this is the starting point, just for explanation sake. Now this is the swing high, right? And this is the swing low. In downtrend, what happens is, compared to the previous swing high, it makes a lower high, right? This is a lower high. Now compared to the previous swing low, it makes a lower low. Okay, lower, it made a lower high, it made a lower low. So in downtrend, price keeps on making lower high, lower low, lower high, lower low. In other words, if the price is making lower high and lower low, we can conclude that it is in a downtrend. Now let's say you have a stock in your portfolio which is displaying this particular pattern, lower high, lower low, lower high, lower low formation. Do you think is it a good idea to hold the stock? Comment below. Let's see whether you understood the concept or not. There is a stock in your portfolio, it displaying lower high, lower low, lower high, lower low pattern, and is it a good idea to hold this particular stock in your portfolio? Just comment below. Let's see whether you understood this or not. Now I will take an example. So this is Nifty weekly chart. So this is the, you can see, right, compared to the previous swing high, it made a lower high, lower low, lower high, lower low, lower high and lower low, right? So it is a perfect example of our downtrend. This is one more example, Adani Enterprises weekly chart. Again, compared to the starting swing high, it is a lower high. Again, compared to the starting low, swing low, it is a lower low, right? It kept on making lower high, lower low, lower high, lower low. So it is in a strong downtrend, right? Now, high up downtrend is also clear. Uptrend, higher low, higher high, higher low, higher high. Downtrend, lower high, lower low, lower high, lower low. Now in sideways trend, this is the third trend. In sideways trend, what happens is, price, this is a high, this is a low. What happens is, price will keep on making the same highs, same lows, same highs and same lows. Okay, now don't assume, or don't think that it should make the proper swing high, same high, same low. For example, if the 1000 is the high, don't assume exactly at 1000 it will turn back. Okay, small, very little deviation is okay. So because in market is, there is no 100% accurate, right? So but just an example, approximately if it going like this, then it is in a sideways trend. So this is an example for a sideways trend chart. So in VRL, it is in a sideways trend in this particular time period, right? It kept on making similar highs and similar lows. This is perfect example for a sideways trend chart. Now let's say you are driving a car in a road. One car is driving or going ahead of you and the right indicator is on in that particular car. Now, do you think that car will take U-turn only? Think for a moment. Now, the thing is, if there is a car going ahead of you, if the right indicator is on, the car can take U-turn. There is a possibility. There is no doubt about it. But one more possibility is, car can take right turn also, right? There is second possibility. Now there is a third possibility, car can go straight as well. Because some stupid drivers have less consciousness about their indicators. They will switch on the right indicator, they will drive straight. They will switch on the left indicator, they will keep on driving straight, right? There is a possibility actually. Now we should apply this common sense. How do you see, for example, when I'm driving a car, if the indicator is on, straight away we unconsciously we do this. So even if the indicator is on, straight away we don't assume he will take a U-turn, right? Or he will take a right turn. We will see whether that wheel is turning, whether the body of the car is turning in the direction. If the body is turning in the direction, it gives a confirmation that definitely he will take a either right turn or U-turn, right? So that's what we do as a experienced drivers. So we should take the essence or lesson from this experience. We should try to apply in price chart as well. Now when the price is in a strong uptrend, if the price makes a, this is a uptrend chart, right? When the price makes a lower high, this is a previous swing high, this is a lower high. So when the price makes a lower high, don't assume, never ever assume price will begin with a downtrend. Recall the car example. It can take U-turn, which means it can go downtrend. It can take right turn, which means it can go into sideways mode. The price can get into sideways mode, or it can go straight as well. So there is a possibility of price going straight as well in an uptrend. So the formation of one lower high is not sufficient enough to declare end of uptrend. I will repeat once again, friends. The formation of one lower high or one lower low is not sufficient enough to declare the uptrend is over. Then this is an example. This don't trust my words. I always say this. Don't trust or believe whatever I'm going to say, because you always back test the concept, you verify that concept on a chart, then only you can believe it, right? So this is an example. See, in this particular mode, the price is in a strong uptrend. Do you agree with this? This is one part. And now it made a lower high, right? It made a lower high, but still it's a proper lower high, right? And still price went upside, right? So this is the perfect example of what I'm going to explain. Okay, what I explained in the previous slide. Now your question is, then Indra, you are saying lower, higher low, higher high, higher low formation is a formation of uptrend, characteristics of an uptrend. Then how do you identify the end of uptrend? Let's say I wanted to exit my stock at the top, then how do I identify end of uptrend? Friends, one honest admission, nobody can exit at the top. Let's say a stock went from 100 to 1000 rupees. Nobody can exit at 1000 rupees. Okay, this is very true actually. So only two people can exit at the top. One is God, another one is liar. So nobody can exit at 1000, but we should try to identify a close point which is very close to the top actually. So in the previous slide, I saw it, one lower high formation is not sufficient for the exit. Now you have a confusion, right? Then how do we identify a close point which is very close to the top actually? Now it is using simple concept, 1 2 3 pattern, how to identify end of uptrend. Let's say you have a lot of stocks in your portfolio. How do you identify end of uptrend for those particular stocks, whether to carry it or not? The pattern is very simple, friends. It is 1 2 3 pattern. Okay, let's say the price is in a strong uptrend. Number one pattern is it makes a lower high formation. The price is in a strong uptrend. It makes a lower high formation. That is number one. Second pattern is it makes a lower low formation. Second pattern is it makes a lower low formation. Third pattern is price breaks the lower low level. Okay, when the price breaks the lower low level, you can conclude that it is end of uptrend. Okay, I'll repeat once again, friends. When the price is in a strong uptrend, first it should form a lower high formation. It is an indication, like a right turn indicator in a car. So it is a warning symbol. Definitely we should be conscious and careful about it. formation of lower low, which means tire is also turning towards that side. Second warning. Third warning is break of lower low, which means car completely turned this side. So this indicates uptrend is over, right? This is a common sense. We should apply the same common sense via 1 2 3 pattern to exit our stocks at the up in an up, I mean when the uptrend is over actually. Okay, so again, don't believe my words. You can see yourself in the chart. This is an example of Tata Steel daily chart. Okay, the price is in a strong uptrend. Do you agree with this? Now price made a lower high, right? Pattern 1 formation. Price made a lower high. Next, price made lower low. Okay, price made lower low, right? It is very clear. Price made a lower low. Pattern 2. Next, price broke that level, right? Price break the lower low level, right? So that is pattern 3 completion. Okay, so this indicates uptrend is over. So if you are carrying any stocks, if the stocks displayed this 1 2 3 pattern, lower high formation, lower low formation, and price also broke the lower low, indicates end of uptrend, you should close that particular stock as much as possible, because you never know when the price, I mean how much fall the stock will witness. So it indicates the 1 2 3 pattern formation, lower high, lower low, and break of that level indicates something is going in wrong with that particular stock. You have to exit. If you observe the chart very carefully, after the break of that level, the same level acted as resistance 2 3 times, right? So that level is very, very crucial. Okay, this is end of uptrend. See, when you see a danger, you should always exit. Okay, so if you can't see a danger after some time, you can always board that particular stock, right? You can always buy back. But once you see the end of uptrend, it is better to exit that particular stock. So this is one more example, Sun Pharma. Again, it is a weekly chart. See here, from here to here, the price is in a strong uptrend. Do you agree with this? Next, at the top, it made lower high. Number 1 pattern. It made lower high. Next, it made lower low. Number 2nd pattern. It made lower low, right? Next, price broke that level. Pattern 3 formation, right? Price broke that level. So it indicates end of uptrend. So if you are carrying any stock which displayed this particular pattern, means you need to close the trade. Again, here it acted as a resistance once the price broke that level, right? Now you can say, Indra, end of uptrend identification is good. We have learned it, but to exit at the end of uptrend, we should be already in trade, right? You should already carrying some stocks to exit at the top end of uptrend, right? Then how to identify those stocks, or how to identify end of downtrend, so that you participate in that particular stock and you participate in the rally and to write the profits. Once again, the logic is very simple, friends. The same 1 2 3 pattern, but on the mirror side. Okay, I'll explain in a simple manner. Let's assume a particular stock is in a downtrend. First, it should make higher low. This completes pattern 1 formation. Next, it should make higher high. This is pattern 2. It should make higher high. Then the price should break the higher high. This confirms pattern 3. So first pattern, higher low formation. This is a warning symbol, which means something is going wrong. Second is higher high formation. It indicates it is confirmation. 3 is breaking. So the break of higher high indicates it is going upside, right? So this indicates end of downtrend. So downtrend is over, or you can also conclude it is the beginning of uptrend. Once the price displays this particular characteristics, you can take an entry. So this is an example of a ACC weekly chart. You can see here the price is in a strong downtrend, right? So it is in a downtrend. Here it made higher low. So this is pattern 1 formation. It made higher high, right? This is pattern 2 formation. Once the price broke that level, this is pattern 3 formation, right, which indicates end of downtrend or the beginning of uptrend. So your entry should come when the price breaks and closes above the higher high level. That should be your entry point, and your stop loss should be the starting swing low. Okay, that should be your starting swing low. Now you might think, or you might get a doubt in your mind that the stop loss is very wide in this particular case. It happens, friends. Dow theory is especially designed for investment to hold your stocks for more duration. If you have the mindset capability to hold your stocks for more than 6 months or 1 year, then only you should use Dow theory in daily charts or in weekly charts. Okay, so your entry should come at or above the higher high level. When the price breaks above the higher high, your entry should come, and when your stop loss should be below the low of the starting swing low. Okay, this is one thing. We'll see one more example. This is JSW Steel daily chart. So this is in a strong downtrend, right? Again, see here, the price made a higher low, right? The price made a higher low, pattern 1 formation. Next, it made a higher high formation, right? This is pattern 2. It made a higher high. This is pattern 2. Next, price broke that level, and the price broke that level, it indicates end of downtrend or the beginning of uptrend. Okay, again you see here, it acted as a strong support. There is a big bullish engulfing candle which came at the same level, right? So that level becomes automatically very, very crucial. So your entry should come above the higher high. Okay, your entry should come above. Whenever the candle closes above the higher high, your entry should come, and your stop loss will be below the swing low. Okay, this is very simple. This is a rule actually. Now the simple conclusion is, see friends, Dow theory, you can also use Dow theory in lower time frames, but it gives valuable insights to market trends, behavior, how the price is going, whether the price is going upside or downside or sideways. If the price is making higher high, higher low, higher high, higher low, means it is in a strong uptrend. If the price is making lower high, lower low, lower high, lower low, means it is in a strong downtrend. If it is making same high, same low, same high, same low, means it is in a sideways trend. Now you can also this Dow theory is highly beneficial for investment and long-term trading and daily charts and weekly charts, but you can also use this in lower time frames as well. But you take any strategy, whenever you get into a lower time frame, there is a high possibility of noise, right? So you should have a mechanism and risk management, money management in place to beat that noise. That is very important. So next, always don't risk more than 2 to 3% of your capital per trade. Okay, what it means is, let's say you take a entry at the break of higher high, and your stop loss is at the low of the swing low. Now if the price comes back and takes your stop loss, means you should not lose more than 2 to 3%, friends. If you have 1 lakh rupees of capital, if that happens, you should not lose more than 2 to 3%. That is the important point. That's very, very important actually. Now once you take the position, if it is better to trial your stop loss below the low of every swing low. For example, let's say you've taken a trade earlier, your stop loss will be the low of the starting swing low, right? Price starts moving upside with higher low, higher high, higher low, higher high, right? Then it is makes sense to trial your stop loss below the low of every swing low. Why? Because there are two options. Safe traders who want to ride the entire move, they can follow the end of uptrend concept, the 1 2 3 pattern formation, to exit the trade. Very conservative traders who want to exit at very safe point, then they can follow, they can trial their stop losses below the low of every swing low. In that way they can exit very close to the top. Next, always backtest the ideas before implementing in live market. So I always say this, let's say you have understood one trading concept, that doesn't mean that it is went into your head and you will be able to take trades based on that particular strategy 100%. Why? Because our mind is very complex system actually. It has a lot of ideas. when you don't back test a particular trading strategy, you don't get 100% conviction and confidence in that particular system. So once you take a trade, if there is a some random movement, your mind will generate lots of ideas, hence you will get a lot of confusion whether to follow that particular strategy or not in live market. But in offline market, when you back test a strategy against at least minimum bare minimum 100 charts, you will get little confidence and conviction to use that particular system.